Let me tell you about Nathan. He's 34 years old, lives in Austin, Texas, works as a senior software engineer at a tech company. His salary is $185,000 a year. $185,000. That's more than 3 times the U.S. median household income. By every conventional measurement, Nathan has made it. He drives a leased BMW, he lives in a modern 2-bedroom apartment with a rooftop pool and a concierge, he eats at nice restaurants, takes 2 international trips a year, wears the right clothes, uses the right products. His Instagram is a highlight reel of someone who has clearly figured it out. And Nathan is completely, quietly broke. Not broke in the way most people picture, no eviction notices, no debt collectors calling. Broke in the way that matters more long term. Last year, Nathan built up a $14,000 credit card balance because his expenses kept outrunning his take-home pay, no matter how many times he told himself he'd cut back next month. His savings account has $1,900 in it. His 401k contribution rate is 3%, just enough to get the employer match, because every time he tried to bump it higher, something came up. His car lease is $1,100 a month. His apartment is $3,400. His subscriptions, gym membership, meal delivery, and recurring lifestyle expenses total another $800. His student loan is $620. After taxes in Texas, Nathan takes home around $10,800 a month. After his fixed expenses, he has about $1,200 left to breathe with, on $185,000 a year. And when Nathan does the math and tries to figure out where the money went, the number staring back at him doesn't feel like the income of someone who's winning. It feels like a trap. And here's what should genuinely alarm every single person watching this video. Nathan is not the exception. He is the statistical norm for high earners in America right now. A Goldman Sachs report released in October 2025 found that 41% of American workers earning between $300,000 and $500,000 a year say they are living paycheck to paycheck. 41%, nearly half. And the number is almost as high for workers making over $500,000. 40% of America's highest earners say they cannot get ahead of their bills. A 2025 Harris poll found that around 1 in 3 Americans with 6-figure incomes experienced genuine financial distress. 3/4 of 6-figure earners said they had used a credit card recently because they ran out of cash, and more than half of 6-figure earners said they would need to double their income just to feel financially secure. Read that again. People making $100,000, $200,000, $500,000 a year saying they would need twice what they make to feel okay. This is the high-income poverty trap. It has a name, it has documented psychology behind it, and it is quietly swallowing a generation of high-earning Americans who look successful from the outside while feeling completely financially insecure on the inside. Today, we're pulling back the curtain on exactly how it happens, why it's so hard to see from inside it, and what it actually takes to escape it. Let's get into it. If you're new here, hit that subscribe button right now because every week we dig into exactly the kind of stuff that most financial channels are too afraid to say out loud. So let's talk about exactly how someone ends up making $185,000 a year and still feeling financially insecure. Because this isn't random and it's not weakness. It's a precise, predictable, psychologically driven sequence that plays out the same way for high earners across the country. The first mechanism is lifestyle inflation, the process by which spending automatically expands to match and then exceed rising income. Most people are familiar with the term, but most people dramatically underestimate how total and automatic the process is. When Nathan got his first raise from $90,000 to $115,000, the additional $25,000 in annual income felt like freedom. He upgraded his apartment. He started leasing instead of owning a car because he could afford the payment. He started eating out more frequently because cooking felt like something he did when he couldn't afford not to. Each of those decisions felt reasonable and even deserved in isolation, but collectively they created a new fixed cost baseline, a floor of monthly expenses that the new income had to clear before he could save a single dollar. And then, when his income rose again to $185,000, the process repeated. Bigger apartment, better car, more travel. The new income was absorbed almost entirely by lifestyle upgrades before it ever had a chance to become wealth. This is what Fortune's October 2025 reporting described directly, explaining why $500,000 earners are struggling. Lifestyle creep and continued spending on luxury items they can't sustain have trapped even the highest income workers in the same financial position as their lower-paid peers. The second mechanism is fixed cost anchoring. Unlike discretionary spending that you can cut whenever you choose, high earners tend to accumulate fixed monthly obligations, luxury apartment leases, car lease payments, private school tuition, gym memberships, subscription stacks that feel like normal life but function like financial concrete around your ankles. Nathan's fixed costs alone consume roughly 53% of his take-home pay before he buys a single grocery item. And fixed costs are uniquely dangerous because they don't scale down easily when income dips or unexpected expenses hit. You can cancel one dinner reservation. You cannot easily exit a 2-year apartment lease or a 36-month car lease. The third mechanism is social comparison pressure, and in the specific world of high-earning professionals in major American cities, this force operates at a level most people outside that world genuinely can't imagine. Nathan's colleagues drive expensive cars, take business-class flights, and live in neighborhoods that signal their status. The baseline of normal in his social and professional environment is extraordinarily expensive, and the psychological cost of visibly living below that baseline is real, measurable, and felt daily. Now, let's go deeper into the psychology. Because the mechanism of the trap is one thing, but understanding why incredibly smart, high-achieving people stay stuck in it year after year is a different and equally important question. The first psychological force is what behavioral economists call the hedonic treadmill, and it's the single most powerful driver of the high-income poverty trap. The hedonic treadmill describes the documented human tendency to return to a relatively stable baseline of satisfaction regardless of positive changes in life circumstances. When Nathan's income went from $90,000 to $115,000, the initial feeling of abundance lasted roughly 3 to 4 months. Then, the new income became the new normal. The BMW stopped feeling special. The nicer apartment became just where he lives. The brain habituated to the upgrade and reset its satisfaction baseline at the new level, which meant he now needed more to feel the same sense of abundance he felt before. This is not a character flaw. It is a deeply documented feature of human psychology that operates on every income level, in every culture, across every measured demographic. The treadmill moves faster as income rises because the upgrades get bigger and more expensive, but the habituation timeline stays the same. The second psychological force is what's called the wealth illusion, the gap between income and net worth that high earners are particularly susceptible to confusing. Income is what comes in every month. Net worth is what you actually own minus what you owe. Nathan's income is $185,000. His net worth, if you subtract his credit card debt, his student loan, and the fact that he owns no assets of meaningful value, is essentially negative. But because the income is high and the lifestyle signals success, Nathan's brain registers wealth in the absence of it. The Harris poll found that more than half of six-figure earners said they'd need to double their income to feel secure, and that feeling is a direct symptom of the wealth illusion. The income keeps rising, but the net worth doesn't follow, which means the financial anxiety never resolves, no matter how many raises arrive. The third psychological force is present bias operating at a high expense level, the same instinct that drives anyone to choose immediate reward over future security, but amplified by the size of the spending involved. Nathan isn't spending $5 on a coffee instead of saving it. He's spending $1,100 on a car lease, $3,400 on an apartment, and $800 on recurring lifestyle subscriptions, all of which deliver immediate, visible, socially reinforcing rewards in exchange for a future that feels abstract and far away. And here's the data point that captures the full scope of this problem at the national level. According to SoFi's March 2026 analysis, approximately 108 million Americans of working age were living paycheck to paycheck at the end of 2025. That number includes a significant and growing slice of people earning incomes that should, by any objective standard, produce financial security. The trap is not about how much you make. It is about the relationship between what you make, what you spend, and what you actually keep. And for a generation of high earners in America, that relationship has become completely inverted. All right, here's the part that Nathan needed someone to tell him 5 years ago, before the lifestyle architecture got so locked in that changing it feels almost impossible. Because escaping the high-income poverty trap is not about earning more. Nathan's entire life is proof that earning more does not solve it. It's about 5 specific, intentional moves that rewrite the relationship between income and wealth. The first move is to calculate your actual net worth right now, today, this week. Not your income, not your salary, not what you think you're worth. Your net worth is every asset you own. Savings, investments, home equity, retirement accounts, minus every liability you owe. Credit cards, car loans, student loans, mortgage balance. If that number is no or negative relative to your income and your age, that gap is the truest single measure of whether the high-income poverty trap has gotten you. The Millionaire Next Door research, now updated in multiple follow-up studies, consistently shows that the median millionaire in America is not a high-income flashy spender. They're a person whose net worth is dramatically higher than their income would suggest, because they consistently saved and invested a meaningful percentage of everything they earned, regardless of lifestyle temptation. The second move is to automate wealth building before lifestyle spending gets the first dollar of every paycheck. This is the pay yourself first principle, and for high earners, it means maxing out your 401k, $23,500 in 2026 for under 50 employees, maxing a Roth IRA if you qualify, and setting up a monthly auto transfer to a taxable brokerage or high-yield savings account before any discretionary spending is even possible. When wealth building is automated and happens before the money hits your checking account, lifestyle inflation has nothing to inflate on. The third move is to conduct a fixed cost audit every 12 months, listing every single recurring monthly obligation and asking 2 questions about each one. Does this actively improve my life in proportion to what it costs? And could I replace it with something lower cost without meaningfully reducing my quality of life? For most high earners, this audit reveals 3 to 5 fixed costs that have quietly outlived their emotional value: a gym they barely use, a luxury apartment feature they stopped noticing, a car lease payment on a vehicle that's mostly parked. And cutting just 2 or 3 of them can free $800 to $1,500 a month that goes directly to net worth instead. The fourth move is to set a savings rate target, not a savings dollar target. A 20% savings rate on $185,000 is $37,000 a year going to wealth building. That's $37,000 that doesn't care about inflation, that doesn't care about market conditions, that doesn't care about what your colleagues drive. A savings rate target scales automatically with income increases, meaning every raise you get, 20% of it immediately goes to your future before lifestyle inflation can claim it. Nathan, after running his actual net worth number for the first time at 34, was genuinely shocked. He started by automating his 401k contribution up to the maximum, canceling his car lease at the end of the term and buying a used vehicle outright, and dropping his apartment to a unit without the rooftop pool for $900 less a month. 12 months later, his savings account had $11,000 in it, and his investment account was building for the first time in his adult life. He didn't earn $1 more. He just stopped letting his income disappear before he could keep any of it. That's it for today's video. If this hit close to home, hit the like button and share this with someone who earns well but feels like they can never get ahead. You might be describing exactly what's happening to them without them even realizing it.